Financial markets often behave like a physical rubber band. When price action stretches too far from the average, the resulting tension usually forces a sharp return to the center. Most amateur traders ignore this tension. They consistently lose capital by chasing breakouts that have already happened, which leads to buying at the top and selling at the bottom. We are going to configure your charts to identify these extreme volatility spikes, allowing you to profit from the reversal while filtering out the traps that catch the rest of the navdeep. Keep in mind that this is an aggressive strategy. You must practice these setups on a demo account before you even consider risking real capital. Trading the snap instead of chasing the move is what separates the traders who grow their accounts from those who eventually blow them. We'll build your charting environment. Change your time frame to 15 seconds and set your trade expiry time to exactly 1 minute. This Keltner channel is a volatility-based envelope showing boundaries of normal price movement. To find overextended prices, change the multiplier from 2 to 3. This expands the indicator to only identify statistically rare levels, filtering out the noise. Expanding this mathematical boundary allows us to ignore standard market fluctuations and focus specifically on moments of structural exhaustion. To confirm these extremes, we need a momentum oscillator. We'll use the Relative Strength Index, or RSI, which tracks the speed and change of price movements. To make the RSI responsive enough for a 15-second chart, we need to drop the look-back period. Change the standard period from 14 down to 5. Next, adjust the extreme zones. Set the overbought line to 90 and the oversold line to 10. This ensures we only get a signal when momentum is at its absolute limit. Under these settings, we are only interested in moments where the RSI line aggressively breaches those 90 or 10 thresholds. Combining a 3 times Keltner envelope with a 5-period RSI creates a selective trap designed to spring only when the market is under extreme stress. For a sell setup, the first requirement is a green candlestick closing completely outside the upper Keltner band. If any part of the candle touches the band, the setup is invalid. The candle must float entirely clear of the line. At that exact moment, check your RSI. It must be at 90 or higher to be valid. For a buy setup, look for the reverse, a red candle closing completely below the lower Keltner band while the RSI hits the 10 level. Requiring a full candle to close outside the band ensures the price is statistically overstretched before you enter the trade. Even when the indicators align, you must watch for a specific failure point, confusing a momentum breakout for market exhaustion. We call this the freight train. It's a vertical candle 3 times larger than the previous ones, and it has almost no wick at the top. This is a sign of strength, not exhaustion. A giant candle without wicks represents sustained, aggressive buying. The rubber band isn't ready to snap yet because the momentum is still building. If you see this type of price action, do not trade. It is better to miss a setup than to step in front of a trending move that isn't ready to reverse. Discipline in trading is about recognizing when the price action contradicts the indicators and having the patience to wait for a better setup. Your technical stack is now complete. Keltner channels at a 3 times multiplier, paired with a 5-period RSI set to 90 and 10. To protect your capital, adhere to 2 requirements. Only trade candles that have closed completely clear of the bands, and never trade against a large, wickless momentum candle. Open a demo account today and apply these settings. Your goal is to identify 5 setups that meet every one of these criteria before you move to live charts. Successful mean reversion trading requires you to let the crowd chase the fake breakouts, while you wait for the exact moment the price snaps back.